Hi, this is Park Sam. Welcome to this episode of the Living and Working Abroad show. A bit of a to-do today, so we're running a bit late as our start time. But if you're watching later, please like and share and comment uh, as appropriate and as you think uh, where we can help you and advise you on living and working abroad for your property, business, and family um, and investments while you're living and working abroad. Today's topic is we're looking at taking a deep dive into tax savings on pensions uh, and specifically tax savings on pension transfers for business and family when you're living and working abroad. It's not what you think. So listen up. Tax saving, pensions, uh, transfers for business and family living and working abroad. So we're going to cover that in more detail in this webinar, and you can like and follow as we go along. But also you can contact us at partnership.com and book a free review consultation to discuss how we could potentially help you. First of all, I want to make a few comments on what's going on in the world, and from a UK perspective at least. Uh, I like CeeLo Green music. You may call me a bit old-fashioned, but I think, what the hell? Anyway, so we've got Keir Starmer taking a lead and taking control for his second year in office, and it's completely the wrong approach that they're operating with, and it's almost, it seems that they're not aware of what they're doing in the past, but they are aware. We've just been announced that the next budget, their second Labour budget, is going to be the 26th of November. So it's not going to be another Halloween budget in terms of date, but it may well be in terms of the people being brought in, because they're more career civil servants, they're more left-wing orientated. So we've got this far left-driven government that's looking to tax and spend all the time, and that are decidedly looking at ways to increase the taxes. And as we've seen over the last year in the UK, if you increase the taxes, somebody's got to pay. The taxpayer pays first, but everybody else pays later. So if you're running a business or you're renting property, or you've got savings and you're paying more tax, then you are going to spend less, you've got less money to spend of your wealth later on, or your business is going to employ less people, or some other um, impact is going to be felt down the line on somebody else. We've got a government that's full of advisors now to the Chancellor are looking at ways to increase tax and spending. And the financial world knows this. We've seen the big crash in British bank values over the last week, as they anticipate that there'll be some more degree pokery, some more adjusting of figures, so that the banks can pay more backdoor tax into the government system. We've got major industry leaders of the major supermarkets and big companies uh, asking the government to stop taxing everything, but it's in their blood. When you've got a career civil servant, not necessarily um, used to being a wealth creator, providing the services for the economy, it's not born into it. We've got this far left government that's looking to raise taxes to spend on public sector spending. But we've got a situation now where the British level of borrowing is higher than it was in 22 when the Liz Truss government collapsed, and it's higher than it's ever been. We've got gilt prices which are a month before the budget, 2 months before the budget, already at a record high, nearly 6% for gilts. That isn't a good thing. That means that uh, all the money that the government taxes to spend, they also have to borrow some more to build the roads, to employ the people, to go on their projects and their tours, and to pay the government and the politicians' salaries. All those things have to be paid for. If there's not enough tax, If the tax income is a shortfall, they have to borrow more, and gilts rates goes up as a result. The 6% interest on gilts has to be paid by taxpayers. So the more your debt is, the more your interest payment is, the longer it's going to take you to get the money back. So the more taxes you need to raise. Or you stop spending. If you budgeted for your family or business and you've overspent, you might just consider stop spending. But the unique thing about governments and politicians is that they've got the power to tax. They make the law, and you've got the law, you have to follow it. And one of Keir Starmer's new um, uh, economic advisors all after this wealth tax. So will we see a wealth tax come in overtly? So in Portugal, you've got a solidarity tax. Over 80,000 income, you have to pay a solidarity tax as a flat rate on your income. And there's other flat rate taxes around the world as well. So a wealth tax could be one way of generating additional income. They could attack landlords again. But again, if you say to a landlord, oh, you're getting this income, we're charging you tax on it, but we're going to charge you national insurance as well, that's fine and dandy. Let's let them pay that additional tax, but somebody has to pass, that bill's going to be passed on. So if the landlord is paying extra tax on his property rental business, then he's going to pass that on to the tenants. So the tenant is going to be paying more rent, or the property value is going to go down, and the capital gains tax liability potential for the government will go down as well. So the more you tax, somebody's going to pay, and it might be the taxpayer initially, but it could be the tenant as well, or the tax on capital gains that the government will pay in the future. Another future tax that they've got is inheritance tax, and there's lots of rumours about how they could change this. At the moment, a married couple could potentially get £1 million worth of allowance from inheritance tax, but it's still the fastest growing tax in the UK. Um, there's 325,000 on first death, 325,000 on second death. There's an extra 175,000 each for UK property assets. So again, will that survive? So if you wanted to increase the tax on property, you could just reduce this additional 175,000 allowance each on inheritance tax. So instead of being the inheritance tax being fixed at 325, which it has been for nearly 15 years, um, it could stay at that, and you lose 150, which 150,000 extra into the inheritance tax equation is another 40,000 for the government each time somebody dies. And with an aging population, you're going to get more inheritance tax assessments in the years ahead. So it may not generate the revenue for them now. The taxpayers are not going to be paying it now. It may give them a chance in their view to get re-elected in the next election, uh, but in the long run, it gives them the right to say, well, we've got this tax revenue coming in, Mr. Money Markets, please lend me some more money, but at a lower rate of gilt charge than the 6% you're charging me now, because we're going to have the money to pay for it in the future. That's the power of being able to make a law and then people obey the law to pay those extra taxes. And at ProAct, we try to advise you on ways and ideas for saving money in tax across border and down generations by following the rules, but not everybody charges as much tax, and not everybody is an expensive luxury as a Keir Starmer government. So let's have a look at some of those. We talked in the past on our webinars about how you can create a family trust, have a family investment. You don't need to go to a big investment company to hold your investments and let them manage all your money. You can create your own. And if you create your own, you can avoid probates, you can avoid capital gains taxes, and therefore inheritance tax in assessment of of a probate administration. Trust doesn't die. And therefore, a family trust is a potentially a way of avoiding inheritance tax as well. Family gifts, very important way of saving money, not completely or outlawed at the moment, but could be in the future. We need to consider making some changes going forward. One last tax that might change, and here's a bit of PR playbook which the uh, Keir Starmer government like to use. They might put up the VAT threshold for businesses. Now, at the moment, post Brexit, VAT was an EU tax. So coming out of the EU, um, uh, uh, forward thinking government could have said, we're going to abolish VAT. We're not in the EU anymore, therefore VAT is going to go. That would be the reward for Brexit. Now, the government may have needed some taxes elsewhere, but unfortunately, the VAT is a tax and spend, so the government gets taxes in from that, so they spend it, and that's all ingrained into the UK system. So it stuck and it stayed even post the EU. Um, so the British government could actually increase the threshold. They're not restricted by EU limits. So if you put up the threshold at which a company starts paying a VAT from the current 90,000 turnover a year to say 100 or 150 or even 200,000, you could then come along and say, we're supporting the small businessman because you no longer need to register the VAT. Thank you very much. But that would be the headline. That would be the PR playbook that Mr. Keir Starmer would use with his Chancellor to say, look at this giveaway. We're reducing the tax burden on small businesses and we're raising the threshold for VAT registration to by 30 or 60,000. You know, maybe up to the level of an MP's salary around about 150,000. But of course, the catch will come that they'll change the VAT rate as well. So if you raise the rate from, I don't know the stats for this, I'm not prepared for this venue to this, but if you raise the VAT threshold from 90 to 150,000, how many small contractors, small businesses would that take out of VAT? It would take some, but not the majority of VAT payers, which would be large multinational and national corporations. But if you put the VAT rate up by 1, 2, 3, 4%, 20% at the moment, so let's say you moved it to their favourite 24% for capital gains tax, um, uh, that would generate an extra 4% on all your spending. It would be given an inflationary blip that they'd excuse because it was a tax change, but everybody would pay an extra 4% on everything, including small businesses that are not VAT registered, and they would no longer be able to get the relief on their spending against their income. So it's a double pronged sword. So watch out for the VAT because if they do increase the threshold for business, uh, and they increase the rate for everybody, then everybody, including small business, families, pensioners, will suffer paying extra tax, one penny at a time on VAT going forward. For more information and guidance on living and working abroad and tax saving approaches with a family business or trust, contact us at proactpartnership.com. The main topic today, and there is a subsidiary one, but the main one is tax saving pensions, uh, specifically tax saving pension transfers for business and family. We offer a free review to clients. I speak to very many clients over the days where they're talking to me and they say, what about this 25% tax that was introduced on my pension a year ago? And yes, it was. In the Halloween budget of 24, um, the, the Labour government introduced a 25% tax if you transfer your pension offshore. Uh, so what's the methodology behind that? A government taxes a tax entity. A tax entity is an individual. It's also a business, a partnership, a self-employed trader, a company, but it can also be a charity or it can be a trust. Under English law, trusts can be a way of a tax entity to hold um, assets which are not a company and are not an individual. So that the charity could be an organisation, or the trust could be a family arrangement to hold property, valuable assets like paintings or cars or boats, or it could be to hold the shares of the family company. So you can build up a portfolio like that. Um, so a business, a company, an individual, a partnership, or an individual or a trust are the tax entities that you can have in the UK. Now, a pension is a form of trust. All pensions are a form of trust, apart from the state pension, nominally, which is just paid out by the government. But if you've got a defined benefits pension or self-invested pension, they are basically, in English law, a trust entity under a special set of rules for pensions. So that a fixed asset in the UK. However, the benefits are paid to an individual. So the individual who's a beneficiary of the income or the lump sum on death of that pension is an individual, and the individual then becomes, when they receive a benefit from that pension fund, that is the chargeable tax event. Um, for the pension. So the individual has got a pension trust. The pension trust has its own tax rules, and when the pension trust pays income out to the individual, a taxable event arises. Now, the added advantage that you've had all your working life is the government contract is that will give you tax relief on the money to go into the pension, but it will be taxable income when you come out. Um, and that's a fair agreement. You can take a 25% lump sum tax free, but the rest will be taxable at your highest marginal rate, which is 45%. So if you're in the UK with £1 million pension fund, you draw that money out, then potentially you've got 45% tax to pay on that, £450. But then you've got 650,000, can't believe I said that, 550,000 cash in your bank, cash free to spend anytime you want without any further tax liability until you die. What was introduced in the Halloween budget was to make that pension an inheritance tax assessment. So previously, if you died, the pension fund could potentially be left to your family without any additional tax charges. It's just a lump sum without any tax. So maybe some sort of tax charge, whether it's an income tax or a capital tax or an inheritance tax, is not that unreasonable in that respect. Uh, but now, pension funds in the UK are taxed when you draw the income in retirement, aged over 55, or when you die, you pay an inheritance tax of 40%, and that's 40% for everybody. It doesn't matter how poor you are or how rich you are, it's 40% assessment of inheritance tax on that pension fund. The two ways that tax could change on that is one is that the tax-free lump sum could be removed. Forget about the contract that you've had for the last 60 years of your working life. They could decide that the tax-free lump sum would be limited. So instead of you being able to draw 25% of a £4 million pension pot, you can only draw 100,000 maximum, say, or half a million maximum. So there might be a cap on the amount of the tax-free lump sum, which would increase the amount that stays in the pension fund as taxable income or inheritance tax in the future. Very easy thing to do. The cap on the 25% tax-free lump sum, the maximum is 250,000. Because anybody who's got a £1 million pension fund, potentially you could generate 5% interest on that. So 5% interest on £1 million is about 25,000 a year. So it's a reasonable income. So if you decided that was going to be the limit, that is the choice that you could make as a government because you've got the power and you've got the control, and it would only affect the wealthy people, and the small people wouldn't notice the difference, and the government's tax take would go up as a result because more money is moved from the tax-free lump sum into the uh, a taxable income or inheritance tax pot. So that is how uh, that works. Now, how else could it work? Is that, um, and we're referring really to all the UK governments over the last 25 years, which have gradually tightened up the rules on pension tax rules so they can get a bigger tax take. At the moment, if you've got a civil service pension, that is uh, well, government service pension, that is taxed in the UK. You can't relocate overseas and have that tax. You could do before 2019, but the rule was changed then, and there's a transition period. But from 2024, I'm just looking at a question that's come in from Tahar. I'll answer that in a few minutes, so I can get back on my topic. Very long question. Thanks for that. Um, the, the, so by 24, all government pensions are taxed in the UK, so you can't move them away. That's not dissimilar to pensions in North America, in USA and Canada. So it could be the second scaremongering thing that the budget could do is actually decide that all pension funds are locked in the UK and that the income stays in the UK, even if you're not UK tax resident. So that's the second choice. But what they did do last year is that they said if you transfer your pension from a UK based pension fund to an offshore fund, we'll introduce a tax of 25% on the fund. So this third tax that was introduced, that the lump sum, if you take your £1 million pension and move it from a UK based pension scheme to an approved offshore scheme, um, uh, that scheme um, would uh, be credited with a fund 25% less, 25% tax less than that. So instead of getting a tax-free lump sum of 25%, you get taxed at 25% when you transfer your pension offshore uh, to an offshore pension scheme. Now, many people say that to me as a way of saying, you know, can I move my pension abroad? You can now if you pay that 25% tax, and then you've got the new tax for you in the UK as an individual. So uh, you've got those three levels of tax. There's another way of transferring your pension abroad at the moment. What you can do as an individual, the individual beneficiary of that pension fund, you can relocate abroad. So if you choose not to live in the UK, but to live overseas and become a tax resident in another jurisdiction with a double taxation treaty, then you can have your pension tax in that other jurisdiction. Now, if you're living in Spain, that might be a tax rate of 24 to 45%, and not much benefit from the UK. But other jurisdictions could have a lower tax rate, and some have quite a preferential rate. So you could live in the Middle East where there is a double taxation treaty and there's 0% tax. In Cyprus, where the Private EU office is based, there's a flat rate tax on overseas pensions of 5%. So if you came to Cyprus, became a tax resident in Cyprus, um, and registered your pension and yourself as an individual to receive that income in Cyprus, you could draw your £1 million pension fund and pay 5% tax. 1 million pension fund, pay 5% tax. In the UK, you pay 45%. The tax saving is 40%, exactly the same rate as your potential inheritance tax liability if you leave it in the UK. But does the inheritance tax liability go away? Well, there is no inheritance tax in Cyprus. That's the secondary point. The fact that you've drawn your £1 million out of the pension fund means that you don't have an inheritance tax assessment in under the pension laws. What you do, and I'm coming back to you, Taha, in a few minutes, so don't go away. What you do is you've then got your £1 million less your 5% tax um, sitting in a pot. Now, there's no reason why you can't invest that in whatever you like. It could be in property, it could be in investments, it could be in a business, but you can create your own family trust. Cyprus is based on English law, so trust law applies. You can create a family trust and put it in there. And a trust doesn't need inheritance tax assessment. It doesn't need probate because you can make it um, beneficial across board and down generations without that inheritance tax liability. Things might change. Things might change in the next budget or any time in the future. But at the moment, uh, the worst case scenario is that you can make yourself as an individual an expat in the UK with a self-invested pension. Doesn't work for defined benefit schemes. Remember, defined benefit schemes are automatically taxed in the UK. State pensions are only paid by the government when you reach the state retirement age. But if you've got a self-invested pension scheme, age over 55, then that fund, you could potentially draw the whole fund for and pay only 5% tax on that £1 million. So, 25,000 tax against 450,000 tax is a big difference. So when people say to me, uh, I don't want to transfer my pension board, there's no point because I'm going to have to pay this 25% tax. That's only if you move the pension fund. If you move yourself and you relocate abroad to a new location and you pay uh, the tax and do the tax returns legitimately over there, then it's going to be less. You may have to buy a residence or rent a property abroad in Cyprus or in another jurisdiction that works for you. You may have to do that. And obviously that would be a different investment choice. But the family trust would then hold the money and potentially free you from inheritance tax because there's no probate uh, process with the trust because you've gifted it away. And family gifts free of capital gains tax. There's no capital gains tax when you die. It's called inheritance tax when you die at 40%. Capital gains tax is up to 24% while you're alive, but capital gains tax doesn't apply when you're dead. And therefore your pension fund, your investment fund is free of all of those when it's a Cyprus family trust. You don't need to be an individual resident in Cyprus to do that. Your company, small business shares can be in there. Uh, as an expat in Cyprus, you can be paying 0% tax on dividends as well. So if you've got retained profit in your UK company, that your UK accountant will say quite rightly, as a UK resident, if you draw it out, you're paying up to 39% dividend tax. Your Cyprus Family Trust or your Cyprus tax residency, you can draw that retained profit from your business for 0% tax. And then make some tax saving planning with your pension funds, freed from the constraints and the tax regime of the UK pension law to be able to plan, prepare, and gift money and hand it down across border and down generations. For more information and guidance on planning ahead um, to for tax saving pension transfers, uh, living and working abroad, contact us at poetpartnership.com. I've got one more topic to discuss, but I'm going to answer Tahar's question now because he said, um, is a scope in bookkeeping and easier to get clients. I'm not sure what that means, Tahar. Have you read that now? So if you're a student, you're studying chartered accountancy, um, to specialise in certain areas. I'm not sure what a QBO, what you mean by that, um, unless it's referring to the software. What we've got is technology. Now, technology comes in. Um, when you say bookkeeping, potentially, when you look at modern day banking, you look at things like Revolut, business banking, um, the way that works with the bank account being linked to your accounting software, it kind of takes away some of the bookkeeping uh, time. You can still do it, but you need a bit more savvy under 30 skills, which as a student you probably have got. Um, but the thing going forward is the advice and what you're looking to do. Um, if you don't reside in the UK or the USA, the laws for relocating into that other country are there, and you have to meet those rules and specifications. And generally, in an EU, UK, or North American country, to come and live and work abroad in that country, you need a special skill from that. And usually an employer sponsor. So if you want to work in the Middle East or the Far East, you need an employer to sponsor you, or you need a special skill to be able to come and set up your business in that country. And for relocating abroad and setting up a business, contact us at proactpartnership.com. I want to look at a bit more now about the pension transfers, because we talked earlier when we were talking about the tax saving pension transfers about the state pension. We mentioned the state pension. So generally, in certain countries, especially the EU and the UK, state pension schemes qualify you for uh, social insurance, qualify you for a state pension when you die. Now, the UK is not in the EU, um, but the UK has got social insurance agreements, not not just tax treaties, double tax treaties, but social insurance agreements with different countries around the world, including the USA, uh, including Canada and New Zealand, and Philippines and Turkey, and the whole of the EU. So if you're living and working abroad and paying national insurance, that can contribute either to a UK state pension or to your home country state pension if you're British. In the EU, it comes around. So any EU country in which you work, with a country in which you retire, you can get your state pension based upon your social insurance contributions in all those countries. And normally there's a minimum amount of years or qualifying years, and it varies when you're living and working abroad. More information and guidance on that, you can contact us at proactpartnership.com. But the UK system is quite like the EU still. There's a form called an S1 or an A1, which you can get. Now, this qualifies you to transfer your healthcare benefits abroad, um, as well as your ability to work. So if you relocate overseas, to try and protect your business from higher VAT costs, or from protect your pension from inheritance tax costs, then if you've got the eligibility to an S1, then you can use that to transfer abroad your rights to state healthcare. Even if you're British, if you're moving to the EU and you're not of state retirement age, if you qualify for an S1, that will transfer over, and that will give you rights to state pensions in another jurisdiction. If you're British and you move into an EU country, um, then you need to pay social insurance generally to qualify for state healthcare, unless you've got this S1 form. Now you can contribute as well into the system, and it works the other way for people from the EU. So if you're in the EU and you're going to the UK um, to work, the S1 can transfer your state healthcare benefits over into the UK, so you qualify for the healthcare. So the S1 is an important form. It doesn't necessarily meet the requirements for medical insurance for a residency permit, but it does enable people to live and work abroad. So if you're a remote worker that's not necessarily paying social insurance or tax in their local jurisdiction because of remote work, the S1 would allow you to qualify as a tax resident while not working for some state healthcare benefits there. Um, the S1 is an important tool for expats living and working abroad. So if you've got some qualifying time in the UK or overseas, then contact us at proactpartnership.com. We want to help and guide you to maximise your state healthcare benefits based upon your national insurance contributions. To finish off, we said that we talked today about tax saving pension transfers. Um, They work around the world, depending upon the jurisdiction, depending upon future tax changes and past tax changes. But what we know today is that if you stay in the UK, your pension fund is fixed in the UK, and you're going to pay income tax up to 45% on it. Um, the death duty when you die is not a capital gains tax; it's the inheritance tax because you're dead. It's 40%, and you can't get away from that for your pension fund. If you transfer your fund abroad, uh, then you've got a potential 25% tax liability. You can't get away from that. But if you as an individual move abroad, then potentially things can start to happen because as an individual abroad, age over 55, you can draw up to whole of your SIP fund and take the cash and pay whatever the local tax rate is. Maybe 0%, maybe 5%, but certainly not 45%. Um, if you're in an English law jurisdiction like Cyprus, they can hold capital assets in trusts, which those gifts are free of capital gains tax liability in the UK as on a deferred basis and enable you to get those further down the line when you're um, uh, uh, when you want to take them, but also more importantly, when you die with a trust, the family trust, you don't need to have uh, a probate administration. There's no inheritance tax assessment on that, and so that the money can pass down the generations as well as cross-border going forward. More information and guidance on tax-saving pension transfers, living and working abroad, contact us at proactpartnership.com. With no more questions, thanks for your question, Tar. Good luck with your studies, and we'll see you next time. Thanks a lot.